our general thought overall is that there's a number of things driving these higher valuations. Some of those make a lot of sense. I mentioned the part about the way of doing business in tech companies, but we haven't even really talked about, again, there is a lot of optimism around the reopening that we have. We're
Welcome to AFO Wealth Management Forward, a podcast about finance, accounting, technology, and entrepreneurship. We apply our decades' worth of experience and insight into what makes businesses work, so we can help others grow both personally and professionally. In this ever-evolving marketplace, we help accounting firms and financial advisors grow their practice through the adoption of holistic wealth management services. Learn from industry leaders and subject matter experts to unlock the secrets of their success. A podcast that shows people and companies the transformative power of technology so they don't fear it, but instead harness it. Don't fight the robots, team up with them. And here are your hosts, Rory Henry, Director of Business Development, and CEO Rob Santos of Arrowroot Family Office.
Hello, everyone. Today, I'm co-hosting with Diane Young, who is a Managing Director here at Arrowroot Family Office. And we have the pleasure of being joined by Josh Hirt, a lead economist with the investment management group at Vanguard. Vanguard is a premier financial advisory firm that offers a wide variety of products, including IRAs and ETFs. As an experienced researcher in the field and a CFA, Josh develops Vanguard's understanding of growth within the U.S. economy. So without further ado, Josh, welcome to the podcast.
Very good. Thanks so much for having me.
Thank you for coming on.
Well, good. Josh, one of the big questions that is on many people's minds these days, besides inflation, what do you feel is the biggest threat to the American economy at this point?
Yeah, that's a really good question. I mean, certainly first and foremost, we've got to get to the other side of the pandemic. That is, we certainly feel like there's light at the end of the tunnel. We think we're entering that phase right now. But very clearly, we've got to see where the pandemic heads and sort of where we get when we, are thinking about the second half of this year and really beyond. I mean, certainly our base case scenarios would be that we've turned the corner. The vaccine's really providing that really positive outlook. But I mean, listen, there's a lot of uncertainty around that, and we certainly wouldn't hope for any other scenarios than what were sort of our central cases. But this whole pandemic has been been full of a lot of different components of it that we wouldn't have expected going in. So I would say very first and foremost, getting to the other side of this pandemic as a country, but also as a world. This is a global issue, so it's really the number one thing that's driving both the U.S. economy and the world economy in general. I mean, beyond that, certainly I think in the near term, some inflationary, questions and concerns have come up. Those will be really big too. But I would also just say that some of the bigger themes that we've been following in our research for a while and have been keeping an eye on, things like inequality. Would be something that would probably rise to my list. Making sure that we have an economy that is going to be working for everyone, that there's going to be contributions coming from a lot of different parties, and that doesn't, the trends that we've seen is that's become somewhat more concentrated over time. So that would be one that I would certainly throw out. Another one is clearly climate change. I think there's a ton of uncertainty around that, what that will mean for the economies and for markets. In our own work, we're really just scratching the surface and getting started on some really deep work on climate change. But clearly, that's another really big macro consideration that affects the U.S., that affects the world. So I mean, those would sort of be three ones that I would throw out there as being just really important. If we're talking about the next decade or so, certainly.
Yeah. And, kind of trying to put things in context, is there any points in American history, Josh, that you could compare to the current state of the economy?
Yeah, I think, it's interesting. In some respects, it's easier to say what we think it might not be, but there also are a lot of flavors of the past in what we're seeing right now. I mean, I would say that clearly, wouldn't have to say that we've never been in a situation like this where the world and the U.S. is coming out of a pandemic a shock to the economy of this size. So there's really no comparison points that would, is certainly in modern time, be able to draw from. But, people are, we are looking at this very much, I would say, in terms of, comparing and contrasting the economy with where it was at the end of the global financial crisis, right? '08 period of time. What does the economy look like there? I think that that's one of those areas we would say it's definitely not like that in a lot of respects. So that would be one. I think in the market, you may be seeing some concerns around, is this something like a tech bubble type of story that you see there? I mean, I would say that we would say it's not as well, although there might be some elements of that are present. Largely, I think that there's, some good reason for some of the gains in the markets that we've seen. So I think that those are two really key ones. The one that we've been focused a lot on, and I think this is very much still a question, but some, getting back to some of the concerns around inflation, some have compared this period of time, or at least some of the pressures that are building relative to maybe a late 1960s, early 1970s period of time when we know inflation really did get out of hand. And I think that's very much an open question at this point in time. We clearly don't know what that looks like. Our view is that it's not like that. That was really something that took a very long time to build. And I think what really characterized that period of time was really rising inflation expectations. People's expectations of what inflation sort of became unanchored. We wouldn't discount that period of time happening, but we don't think it's a high probability event. So I think there's a couple of scenarios where we could say that there's bits and pieces of history in that, most certainly.
One of the questions I'd have for you is, I'm seeing, especially in the area I'm in the Midwest, unemployment is actually way down. Yet everyone's hiring. There's, I just went to a store today and they were closed because they didn't have enough workers. What is going to entice the worker back into the workforce? Is it all safety? Is it all wages, a combination? Or I feel like a lot of people have suddenly had epiphanies and have decided they don't want to do whatever they were doing before.
Right. I mean, there's so many things about this economy that we have a lot of unanswered questions right now, and we're doing a lot of work right now on what does the reopening look like, and trying to get to the heart of some of these questions. I mean, the reality is that the economy has changed a whole lot in just a year. I think it's done a number of things structurally to the economy from a standpoint of, the first thing that would probably come to mind would be just the acceleration at which we've digitized our economies. So things that were really already, there were some trends moving in those directions, like more online-based shopping, maybe like more working from home, flexible work arrangements, things that were sort of, these trends were moving in that direction prior to this. But, we probably brought forward 5 years of that into the span of, 3 months. So that has, caused a tremendous amount of change. And I think it probably, I would say that's sort of the more fundamental structural side of it. And then there also is a mental component of it. I think there's people that, have been working from home for an entire year, and they may have had to drop out of the labor force due to maybe caring for someone or school situations with children, and it may have changed their perceptions about what they want to do, what kind of work they want to do. So I think there are a tremendous amount of these things that are going on. But more directly to your question, I think that has become something that was sort of a fringe. Maybe there was a few articles going on about maybe some labor shortages, maybe in certain pockets of the country. I think that is becoming more widespread. We would still see that pretty concentrated in a certain type of sectors. So, we've really termed the face-to-face type of sectors. Things that where labor is very much engaged in dealing face-to-face with people. You think about restaurants, things, accommodation, hotels, travel, large-scale entertainment. A lot of those services typed employment areas that really were tremendously hard hit in this pandemic. That is where, as we see things coming back online, we're seeing some mismatches of that. And I think that we should expect that. we're expecting that there's going to be some unevenness in this recovery as we get through the rest of this year. Demand probably coming back faster than supply. And that's actually not untraditional. You tend to see that happens first, where demand sort of pulls labor and supply back in. And I think you'll see some components of that in this recovery as well. But there may be certain sectors where you're seeing that, and in certain areas of the country, to your point, where we'll see that very acutely taking place. So I would say that should be expected, throughout this. And I think at some point, that will draw, people that are on the sidelines right now. We don't have a super clear view about why people are on the sidelines.
Mhm.
We know that there's some general buckets. We know that a lot of that actually was, people sort of on the cusp of retirement, and they said, well, I was close enough. It's time to, I'm going to hang them up right now and, kind of move on to the next phase of my life. We know that that's actually a really big component of people that are not in the labor force relative to where they were, pre-COVID. We also know that there's a tremendous amount of the care element, so people looking at schools, parents needing to be able to provide time with their kids, that's a big component of that. We probably don't see that coming back more online until next school year. I wouldn't think we're going to see a tremendous amount of that change between now and then. Obviously, summer coming up in a lot of areas in just a few weeks, so we're not expecting that to be a component of that. And then the third bucket is really that unknown. It's that face-to-face service sector where we think that some people have transitioned into other jobs, into other sectors that were still online. And some are probably still waiting on the sidelines, and we don't have a clear indication of that. Certainly the very generous unemployment benefits are something that factors into that equation. Those won't run out until September. So I think that there's, but at some point, if someone's willing to pay you enough, we would think that probably will draw folks back. And, so I think there's a lot of dynamics going on here, but we should expect some of that unevenness, throughout the rest of this year.
Yeah, that makes total sense. And you talked about, digitizing the economy and kind of segue into technology here. And, we had an interview with the Wall Street Journal markets analyst about SPACs. And, there was a SPAC deal that just went through for Grab that did a valuation of 40 billion. Can you kind of talk about the current valuation multiples? Are they sustainable? Are they justified, especially, with a lot of these tech companies?
Yeah, I mean, I think there's a couple stories going on there with the view of the market. I mean, overall, our view of the market is that probably we're at the top end of what we would consider fair value. But I think we're not necessarily suggesting that that's a bad thing, and that some of that may be very much explained by where we're going in the economy. And I think, we have a lot of different models that point to those things, but even just anecdotally and sort of the narrative around that, getting back to what we talked about earlier, the economy has changed a lot. And those companies, there are a very, we all know that those large tech companies that have been very well positioned for this move, and they also happen to make up a very large percentage of some of your major indexes. So they've done very well with this. And by the way, we think they'll continue to do well because the economy, we think will continue to sort of be in that vein, and those will be favorable ways of doing business. So I think that that's one component of it, because you don't see those stretched valuations in some of your more fundamental sectors. Some of, again, those service sector type companies, or even things like financial and some of your travels, they're not back fully to where, you would think that they would be. So there is some unevenness in this recovery, even though overall, a lot of optimism. And even getting to some of your, the comments about some SPACs and different things of that nature, certainly some areas of the market where you might say, bat an eye at sort of some of what is going on in some of these areas. But I think, our general thought overall is that, there's a number of things driving these higher valuations. Some of those make a lot of sense. I mentioned the part about, the way of doing business and tech companies. We haven't even really talked about, again, there is a lot of optimism around the reopening that we have. We're really just starting to reopen the economy. So that's a component. And then I would say the policy side is really contributing to this as well. The huge amounts of fiscal stimulus and fiscal support that we've seen come into the economy have really almost taken out your left tail in your downside scenario in a lot of areas because there's been so much provided. And I would even say that the central bank and the Fed has also provided tremendous support, continues to provide support, and really has communicated to the market that they will be more or less on hold for a number of years. So, very low interest rates for a number of years combined with those other factors, I think, do a very good job of probably telling this overall story about where we see valuations.
Yeah, to kind of piggyback off that too, I know on another Vanguard podcast, one of your colleagues was talking about the quantitative easing. The Fed started buying bond ETFs back in March, and they cut the short-term interest rates, which is similar to what they did in the global financial crisis of 08 and 09. But this was different because it involved the bond ETFs as a vehicle. Can you kind of explain to our audience, Josh, the difference between what happened in 08 and then what effect this easing has done in the last month?
Yeah, I think it's hard to understate just how how instrumental the policy implementation, both fiscal, but also even just focusing your question on monetary policy, how much it's done, very likely to stabilize the situation that we're in. One way to think about it is just picture the world that we could have been living in back in March when markets were extremely volatile. Had the Fed not stepped in, I think you'd be seeing a very different, probably 6-month period than what we just saw. To describe about some of the differences, I would say that they were both more aggressive in terms of timing. They really entered, they really eased financial conditions very aggressively, very early. And the scale of what they did was, many times over what they did in the financial crisis. So they got themselves involved in different markets, as you mentioned, the corporate markets, the muni markets as well. So really, I would say the broad purpose of what they did was to restore financial conditions and calm the market and to allow some normalcy to come back into the market. The downside of that is if you think about the financial crisis, back in 08, you really had a market crisis in one area that then it sort of fed into the real economy. It was segmented in housing and then it really hit the market and it fed itself into the real economy. And we know how long it really took to wind itself out, really a decade before you could say we had some sort of a recovery. So I think the thinking both this time was really to go big, go bold, very quickly. And it's very likely that quick action, may have saved a lot of downstream scarring and effects that may have happened along the way by allowing markets to sort of return to some normalcy.
One of the questions I'd have for you is we're talking about, what the government can do and that the infrastructure bill that, we know will have to go through the sausage maker of Congress, but I'm assuming something's going to come out of it because, people do realize we have to invest in our infrastructure. How do you think that's going to impact? I was wondering about like the municipal bond market, because a lot of these cities, government agencies are going to get an influx of money. Is that going to be good or bad for the muni market?
Yeah, I mean, to your point, there's still a lot to get, to get found out here in the process. I mean, in general, I would say that, we very positive on sort of what the intent of the bills are. There's a lot of really great stuff, both for the economy now and also likely longer term, especially if it's done well. Some really good things in terms of, rebuilding some of our infrastructure, looking to maybe boost some areas of human capital through some of the education programs. So some really positive things in that nature. We just have to see how they look in terms of getting implemented and such. But I think, even if you were to take so I think a lot of that, we've got to see how that comes out in terms of the funding of that. But even if you were to take the view for the muni market that supply maybe there's some crowding out from the federal government by what is maybe more traditionally some municipal markets. Maybe we'll say that there's some crowding of that out. Maybe there isn't quite as much supply. for a period. I would actually say that given what's going on with the tax proposals as well, and the positive side on that, that it actually might be a pretty good story for demand of munis. So even if you just said less supply, same demand, probably a decent, story for munis. But, as we know, a very likely move in the tax policy, which is, would benefit munis tremendously. I think that there's, at least right now, a positive outlook for, sort of the fundamental components of the, supply demand on the muni market.
Great.
All right. And let me ask a little bit about this. We had a study that we saw from Civic Science that found, 87% of Americans who were polled say that they are at least somewhat concerned about the increasing costs of household expenses. Here, Josh, could you take a moment and speak about, this inflation ramping up here in the near future?
Yeah, sure. Definitely one I would say probably the key risk to markets and the key theme, beyond the health outcome side of it that's going on right now, and something that we think will probably persist for some time. It's pretty clear that we are going to see a rise in inflation over the next probably 4 months or so. A lot of that is just going to be a math-based rise, as we look at inflation really on a year-over-year basis on a trailing 12 months. The 12 months from last year, which were very weak, are going to be rolling out of the calculation, and they'll be replaced with more normal levels of inflation now. But what that will do is it's probably going to push up inflation, well above 2%, probably 2.3, 2.4-ish range for a period of time. We expect that boost to be purely transitory. Certainly there is that math component of it, but there is also the component that I mentioned earlier, talking about as supply and demand come back online. We do see some mismatches and imbalances there. That's likely to drive some pressures going forward as well. But we wouldn't see those as sustained. And so that we think as we sort of get towards the end of the year, the second half of the year, we should see those inflation pressures moderate back down towards the 2% mark, probably even a little bit below 2%. So it's a near-term wise, besides just some of those transitory boosts in inflation, we wouldn't see an outside risk at being concerned about that. Longer term is where we're doing a lot of work and just, trying to understand some of those dynamics, because, getting back to some of the fiscal programs, the infrastructure programs that we just talked about, a lot of public spending coming online. And so we definitely think that will boost some of inflation, as well as just the Fed's own stated objectives now that they're probably going to allow the economy to run hotter than it previously did. That should, boost inflation beyond maybe we've become comfortable seeing, which is, really below 2%, somewhere around 1.5%. We should see that normalize back to, a little bit above 2% range as we get through the pandemic. But, I think the big question out there for markets and, even for us as well is, what are some of those longer term effects of this really, are we really overfilling the bucket in terms of the fiscal and the policy support that's been put in to the economy? What would overheating look like? We think that if those are elements, they would be a little bit longer run.
And it brings up the big question I have is like with inflation, wages are going up. McDonald's was paying people $10 an hour. Now they have to, whether there's a law or not, pay them $15 an hour just to get them off the sidelines. Are these companies taking that into effect when they look at it? So when I look at a company and I look at their earnings and what analysts are saying, are they taking these wage pressures into account for that?
I think so. I mean, I think you will see this impact. This will have an impact, certainly. I would also, at least in the short term, I would argue that there's probably some room, even if they were going to take a slight earnings hit, to ramp up, labor and even pay them higher wages, to raise real wages, that there probably is some room for that. Earnings have been very strong, for just looking holistically at, corporates. So there probably is some room there if they wanted to pass that through. But I think, it's also not clear. And in fact, they may need to do that. Demand may be so strong this year that they will do better by bringing people on board. If we see some of the effects that we are expecting with the reopening really centered around the second and third quarter of this year, their alternative would be to just be able to not meet demand, and there would just be a lot of capacity constraints likely. So it may be that that's a better way.
All opinions expressed by Rob Santos and Rory Henry on this website podcast interview are solely their opinions and do not reflect the opinions of Arrowroot Family Office LLC or their parent company or affiliates, and may have been previously disseminated on television, radio, internet, or another medium. You should not treat any opinion expressed by anyone as a specific inducement to make a particular investment or follow a particular strategy, but only as an expression of their opinions. Past performance is not indicative of future results.